you guys learned a lot from that question. Now let's have a look at another example for Unit 9. So we are told that Giant, a company based in Adelaide, South Australia, they manufacture some wind turbines. The company issued a 3-year corporate bond for $4,010,000. The bond has a face value of $4 million, fixed annual interest payments of 5.5%, paid on 31st of December each year. So it looks like this bond is paid on an annual basis. So the bond was issued at a price higher than the face value because the coupon rate was above the prevailing market interest rate. Transaction costs on the issue of the bonds were $75,000, and the effective interest rate is 6.1092%. Now it goes, Giant has not elected to classify the bond at fair value through P&L and will classify the bond at amortized cost. Okay, so the task here is how do we determine the journal entries for amortized cost? So first things first, we need to understand how much we issued the bond. Okay, so how much did we issue the bond for? Okay, so remember we issued the bond for, again, anyone like to take a guess before I just go through the answer? So how much should we issue the bond for? Again, it's not a trick question. So maybe another way of asking this is, when the company issues a bond, do you think that this is a financial asset or do you think this is a financial liability? Let's think about it from that perspective. Okay. Yeah, so the bond was issued for $4,010,000, but is this a financial asset or is this a financial liability from the company's perspective? Okay. What do you guys think? When a company issues bonds, is that a liability or is that an asset? Okay, it's going to be a financial liability. Okay, so they're issuing bonds, right? So in other words, they're borrowing money from the market. So with this type of transaction, because it's a financial liability, the closing balance of the bond is going to be what has been issued minus the transaction costs. Okay, so you can see that the first entry that we need to recognize is going to be this cash that we've received and this liability that we have assumed. Then we need to go and calculate what the loan amortization schedule is going to look like. So the interest payment, which is this $220,000, to calculate the interest payment, we need to use 5.5%, because that's the coupon rate, multiplied by the face value of the bond, which is $4 million. We don't multiply this by 4.1 million. We don't multiply this by 3.935 million. But we calculate the interest repayment always based on the face value. Okay. Now the interest accrued using the effective interest rate method, this is when we begin to use our closing balance. Okay, so which is this 3,935,000. We multiply this by the effective interest rate for each of the methods, for each of the years. And then finally, we've got this principal repayment towards the end. So you can see that over a 3-year period, the bond has been fully amortized. Now, writing the journal entries for this is going to be much more straightforward once you know that the bond has been amortized. So at the end of the X6 year, so at the end of X6, what's happened is that we have recognized the interest expense. Okay, so this is the interest expense that we recognize using the effective interest rate method. Debit 240,397. we have to then credit the cash because that's how much we have actually paid out as a payment. And then the difference between the two is going to go into credit the corporate bond issued. Okay, because there's a difference between the two. And that, of course, needs to go into the credit because the debit amount here is higher. So now let's have a look at another version of this. Okay. So an alternative proposal, the company at the time was to borrow 4 million from the bank at the same coupon rate of 5.5% and an upfront fee of 65,000. The loan commenced on the 1st of January, would have been repaid with 3 even payments of $1,482,606 made on the end of December each year. Okay. And the payments include both principal and interest. And again, this is going to be measured at amortized cost. So you can see that for scenario B, what we need to do in this question is we still need to set up our loan amortization schedule. But you can see that we need to, in this particular case, we need to work out what are the principal repayments. Okay, so the closing balance is still going to be the same as how we treated the bond that we issued, which is the amount that you receive minus any transaction costs. Now then, okay, we need to work out, well, what is going to be the principal repayment, okay? So we're told that the principal repayment, okay, so we're told that the loan would have commenced on the 1st of January and would have been repaid with 3 even payments of 1,482,616. So we know that both the principal and the interest payment, when we add these two components together, that's going to equal 1,482,616. Okay. But how we calculate the interest payment is that we need to use, again, the face value of the loan multiplied by the interest rate, which is 5.5%. And then the interest accrued using the effective interest rate is we need to take the opening balance, which is 3,935,000. We multiply that by 6.3849% because that's the effective interest rate. Okay, and so you can see that we end up with these principal payments as well. So you can see that in this case, the closing balance of the loan is going to be much lower because we make these pretty large principal repayments each year. And then when we go into the next year, okay, how we calculate the new interest payment is that we need to take how much of the loan was paid back. Right, so we started with the loan that was worth 4 million, but we paid back 1.262 million in the first year. And we then calculate the interest rate on the remaining amount that is left on the loan. And then this interest accrued using the effective interest rate method, again, uses the opening balance multiplied by the effective interest rate, okay, which is again the 6.3849%. And this principal repayment here is just going to be the difference between 1,482,616 and this interest payment. Okay, and so when we do this, we end up with this amount here. And then finally, for the last year, there's going to be interest, which is paid. There's still going to be the principal repayment. And then we have our interest accrued using the effective interest rate method. So we pretty much apply that same type of process until the final value of the loan is 0. So what's the difference between these two methods is that in the first method, you can see that we only repay the loan towards the very end of the term. Whereas in the second method, which is like more like a mortgage, you have to make regular principal repayments. And I think once you have this table, again, feel free to practice this yourself. It's going to be really important. But once you have this table, you can easily then write the journal entries. Okay. And so they're really just going to be the same. So now let's move on